In 1935, a farmer in Iowa sold his land for $8,000. In 2024, that same plot sold for $12 million. The farmer worked it for 40 years. The person who bought it from him never touched a plow. Neither did the next 4 owners. One grew corn, the others grew wealth. This isn't a story about farmland. It's about the asset class most people don't notice until it's already made someone else unimaginably rich. And the quiet part nobody says out loud is that you were never supposed to be in the room when it happened. Right now, there's roughly $330 trillion of wealth in the world. Stocks get all the headlines, crypto gets the hype, gold gets the doomsday preppers. But there's one asset that's larger than all the stock markets on Earth combined. It doesn't tweet, it doesn't split, it doesn't have a ticker symbol you can check on your phone at 2 in the morning. It just sits there, appreciating. We're talking about real estate, but not the kind you're thinking of. Not your neighbor's Airbnb, not some condo in Miami with a lazy river, not even the house you're living in, which, by the way, is probably making your landlord wealthier while you sleep. We're talking about the version of real estate that billionaires buy in bulk and never talk about at dinner parties. The kind that doesn't show up on Zillow. The kind that runs on debt, subsidies, and a tax code written by people who own it. It's boring, it's invisible, and it's how the quiet money gets loud. Let's start with the basic math, because the basic math is where it all breaks. You buy a building for $10 million, but here's the thing, you don't actually use $10 million of your own money. You put down $2 million. The bank gives you $8 million. You are now leveraged 5 to 1. If that building appreciates by just 10%, it's worth $11 million. You sell, pay back the $8 million loan, you walk away with $3 million. You just turned $2 million into $3 million. That's a 50% return on your actual cash. The building itself only went up 10%, but you didn't buy the building with building money. You bought it with leverage. Now let's add the next layer, because it gets better, or worse, depending on where you're sitting. While you own that building, you rent it out. Let's say it generates $500,000 a year in rental income. That covers your mortgage, your property taxes, insurance, and still leaves you a little cushion. You are being paid to wait for the asset to appreciate. The tenants are literally financing your equity growth. And here's the part that makes people's heads spin. You get to deduct the mortgage interest. You get to depreciate the building on paper, even while it appreciates in real life. So on your tax return, you might show a loss. In your bank account, you're compounding wealth. This isn't a loophole. This is the design. Now, zoom out. The wealthiest people in America don't just own one building. They own portfolios, dozens, hundreds. And they don't stop at residential. They buy industrial parks, office towers, warehouses, data centers, the boring infrastructure that nobody thinks about until Amazon can't deliver a package. In 2008, when the housing market collapsed, everyone said real estate was dead. Blackstone, the largest private equity firm in the world, spent that year quietly buying tens of thousands of foreclosed homes, not to flip, to rent. They turned the American dream of home ownership into a subscription model. Today, Blackstone's real estate portfolio is worth over $1 trillion. They didn't get lucky, they got liquid when everyone else panicked. Because here's the thing about real estate that makes it different from every other asset. People always need somewhere to live, somewhere to work, somewhere to store things. Demand is structural, supply is controlled. And if you control supply, you control price. In 2021, investors bought over a quarter of all single-family homes sold in the United States. Not families, investors. That number used to be under 10%. The average person is now competing with private equity funds that can pay in cash, close in a week, and never blink at an appraisal. You're not just losing the bid, you're losing the game. Now let's talk about what gets sold to you versus what actually happens. The story you hear is that real estate is a safe, stable, long-term investment, and for the person holding it, that's mostly true. But for the person priced out of it, it's a trap door. Rent goes up every year, wages don't. The gap widens, ownership becomes more distant, wealth concentrates. And here's where the absurdity really sets in. The same people who own all this property also benefit when housing prices rise because it makes their existing assets more valuable. So there's no incentive to build more. In fact, there's every incentive to restrict new construction. Zoning laws, environmental reviews, neighborhood committees, NIMBYism dressed up as preservation. It's not a conspiracy, it's just incentives playing out in slow motion. Meanwhile, politicians on both sides talk about the housing crisis like it's a natural disaster, like nobody could have seen it coming, like it's not the predictable outcome of letting asset appreciation become the engine of middle-class wealth while locking out everyone who wasn't already in. So where does this go? Right now, the average home price in the United States is over $400,000. In 1980, it was under $90,000, adjusted for inflation. Wages have not kept up, not even close. Home ownership rates for people under 35 are at the lowest point in decades. Not because young people are lazy or spending too much on avocado toast, because they've been systemically outbid by people and entities with more capital and better access to credit. And it's not just homes. Commercial real estate is facing a reckoning. Office buildings are half empty, malls are dying, but the debt tied to those properties is still very much alive. There are billions of dollars in commercial real estate loans coming due in the next 2 years. If property values have dropped, and they have, those loans can't be refinanced at the same terms, which means defaults, which means the people holding that debt, mostly banks and pension funds, are about to take a hit. So the very thing that made people rich quietly might also unwind quietly, just in a different direction. Here's the part nobody wants to say out loud. Real estate works brilliantly as a wealth-building tool if you already have wealth. It's a compounding machine. It rewards patience, leverage, and access. But if you're starting from zero, or worse, starting from debt, it's a ceiling you can't break through. And the people above that ceiling don't need you to break through. They need you to keep renting. The system isn't broken. It's working exactly as designed. The question isn't whether real estate is a good investment. It obviously is. The question is, for who? And the uncomfortable answer is that the best investments are the ones most people can't access until it's already too late. By the time you hear about it, someone else has already made their generational wealth. That farmer in Iowa sold too early, but the person who bought from him sold at exactly the right time, and the person after that is still holding. The asset didn't change. The owner did. If this kind of breakdown is useful, this is exactly what the channel does. No hype, no shortcuts, just how the system actually works. Subscribing just means you won't miss the next